R is return, stock return.
Good afternoon, Professor Cindy and classmates. Today I would like to present my proposal. My proposal is entitled Re-examining Retail and Volatility Spillovers on for Asian Dragon Stock Markets. Re-examining, it means that the study about this phenomena is already so many. Then this is only I do this proposal or this research to replication among the previous research among several in emerging stock market. Outline in this proposal, I have three stages. The first one is introduction, the second one is literature review and hypothesis development, and the last one is methodology. We start with introduction. Between the mid-1950s and the early of 1990s, Taiwan, Singapore, Hong Kong, and South Korea, so-called the four Asian dragons or the four Asian tigers, were experienced rapid industrialization, technological innovation, and development. As we can see, the four countries have the high growth rates around 7% per year. It's according to Bhatia and Gupta in 2018. Before the Asian financial crisis in 1997, the economies of East Asia and Southeast Asia, in this term, we have three East Asia countries, such as Taiwan, Hong Kong, and South Korea, and one from the Southeast Asia, so-called Singapore. They have a sustainable economic growth and a macroeconomic stability, according to CN in 2011. And in the 1997, the Asian financial crisis was the first significant setback for the four Asian dragons economies. As we can see that the stock market in Hong Kong was exposed to a wave of speculative attacks. And then the high level of non-performing corporate loans caused a significant stock market crash in South Korea. However, Taiwan and Singapore were minor damages. Fortunately, all of the four economies made a successful recovery. This is according to Gay in 2003 and Khan and Wu in 2009. This study will focus on Asian markets because they are Asian emerging stock markets. This is according to Lee and Giles 2015. Emerging markets have long been a common preference for foreign portfolio investors seeking the diversification. These markets have inspired the attention of foreign investors because of the reason that I have mentioned before. Then, therefore, they tend to invest in the emerging market. So many investors from foreign or from the developed market will invest the stock in the emerging market. For foreign investors, emerging market offer higher returns and possible diversification benefits, according to Fu, Holmes, and Choi in 2011. We have several prior studies according to the volatility and return in terms of the spillover effect. The remainder of early research on the return and the volatility spillover effect concentrated on the developed markets, as we can see in the several last study by Hamau and Masulis and Ng in 1990s, Caroli, and then Kotmos, and then Lin, Nelson, Poon, Sasmel, Terus and Lee in 1993. This research is focused on the concentrated on developed markets in terms of the return and volatility spillover effect. And then, over time, the focus has shifted from return and volatility spillover of development, or from development, from this one, to the emerging markets. This has already been studied by several studies. I think is still lack of study, because of if we put the spillover return and volatility in the Google, we have so many topic or title about these terms, but I only put a little bit studies, previous studies, according to the return volatility spillover of developed to the emerging market. And then beside these two focus on the return and spillover effect, nowadays there has been an explosion of research into regional emerging markets of return and volatility spillover. As we can see, so many researchers that have already been focused on this case. It means on the emerging market. So for example, Brahmoku Abasis is from Turkey, then Bosma, and then Chelik, Gursey, Hong, Johansson, Kutlu, Mukherjee, and then Ronnie Workington and Yilmaz, the recent study. As you can see, for example, Yilmaz, they developed in 2009. They developed a spillover effect formula to explain the return and spillover effect. This is the, I think, the history of the remainder studies according to the return and volatility spillover effect. And if you can see that from the 3 pages of this topic, they have several findings. For example, they will found there is no volatility of return, or there is no spillover effect of return volatility. Maybe they have a one-way spillover effect on return volatility, and then they have a two-way or bivariate spillover effect on return and volatility between each country. And then the study's main objectives are to determine the return and volatility spillover effect of stock market indices in the 4 Asian dragons, as I said before. The study was motivated by the fluctuations implication of stock prices in financial markets during the Asian financial crisis, global financial crisis, and the COVID-19 outbreak. Understanding this phenomenon is an important issue for portfolio manager and decision makers when they want to expand their investment. So it is important for estimating or analyzing or assessing the risk of a regional diversified portfolio. That's why at the beginning I said that so many foreign investors will do to invest their fund to another country in order to diversify their portfolio. And then the study contributes to complement the literature that focus on the spillover effect of return and volatility among the stock markets. That, as I mentioned before, that the study only to replicate before studying the previous study or the prior study according to the return and spillover effect on volatility. And then the second stage is literature review and hypothesis development. The essence of financial market interdependence, both return and the volatility, has been debated. I think I've mentioned before that so many from before 1990s, there are several studies about the spillover effect of return and volatility. The essence of financial market interdependence of both return and volatility has been debated, especially since the Asian crisis of the late 1990s. This, if you see some paper, we see the statement of Diebold and Yilmaz in 2009, Forbes and Gobon in 2002, then King, Santana, and Madani in 1994. Based on this history, we can divide them in three phases. For example, the one is there are several study focus on the return and volatility spillover on developed markets, and then they focus on return and volatility spillover of developed markets to emerging markets. Then the third one is they focus in return and volatility spillover among emerging markets. Based on these three type of research, we have grouped them into the three groups. One is the stock market have a two-way relationship of return and volatility. Second is there is a one-way relationship of return and volatility among stock markets. The last one is there is no relationship of return and volatility among them. It means among the stock markets of each country. So, based on this gap, we can develop 6 hypotheses. We start from hypothesis 1. There is spillover effect on return and volatility between KOSPI. KOSPI is a stock index for the South Korea, and then the Hang Seng Index. This is stock index for the Hong Kong stock market index. And then the hypothesis 2 is there is spillover effect on return and volatility between Straits Times Index is index for Singapore, and then SI from the for the Hong Kong index. And then hypothesis 3, there is spillover effect on return and volatility between the Taiwan weighted index, and then it is from for Taiwan, and then for the Hong Kong. Then hypothesis 4 is there is spillover effect on return and volatility between the Straits Times Index and KOSPI, means for South Korea. Then hypothesis 5 is there is spillover effect on return and volatility between Taiwan weighted index and KOSPI. And then the last hypothesis is there is a spillover effect on return and volatility between Taiwan weighted index and then Singapore index. This is for the abbreviation for each index of each country. Maybe at methodology I will explain it more clear. Then the last stage is according to methodology. We talk about data. The study comprises the monthly closing price of the stock indices for the 4 stock indices. For example, Taiwan weighted index, KOSPI, Hang Seng, and then Straits Times Index. And then we obtain the data with the monthly data, but later I will consider how if I can using the daily data. But when I try to using the data filtering, I look so many data, maybe 1,000 data, and then I should filter it one by one. Maybe I will consider whether I will use the monthly data or I will use the daily data as well. And then this daily data, this comes from the Yahoo Finance website. We can see in the table 1 about the stock indices in the 4 Asian dragons. For example, Hong Kong or East Asia, its indices is Hang Seng Index, the abbreviation is HSI. Then Taiwan from East Asia, its indices is Taiwan Weighted Index, the abbreviation is TWE. Then South Korea from East Asia, its indices is Korea Composite Stock Price Index or KOSPI. Then the last one is Singapore, comes from Southeast Asia. Its indices is Straits Times Index or STI. This is the 4 indices that I will develop in further analysis. And then based on the my hypothesis, I develop stock indices pairs, and I develop 6 pairs based on my hypothesis before from KOSPI. And for example, I should maybe in this pairs I will get slightly different sample. Why? Because of each pairs will have maybe several data will be not applicable or lost from the my observation. That's why later each pairs will have the different number of the samples from Kospi and Hang Seng to the Taiwan Weighted Index and Singapore Strike Rate Index. Before I run the further analysis, in order to make our data is smooth, in order to we diminishing the several data, yeah, that will be higher or low. In this case, I'm using the returns measurement by a logarithm. For example, the year t is equal to log pt, or closing price t is minus the log of closing price in t minus 1. It means that if I use the monthly data, it means that I'm using the closing price in current month, and then minus the log closing price in the last month. In this case, why I use the data from 1997 July until 2020 31, I have several reasons. For example, I consider the Asian financial crisis in July 1997, then global financial crisis, then in the September 2008, and the last one I consider the COVID-19 outbreak that start from the late December in 2019. Then the model that I consider in this proposal, I using the GARDS and ARMA model. This model actually I developed from the Chen and Huang 2010 model. This model only focus on the GARDS and ARMA, but the Chen and Huang focus on the eGARDS model. Maybe more extended than my proposal this time. For example, using the stock index return model, as we can see the two model from the R subscribe E dot T or time, and then superscript M. This my focus to analyze the ARMA model. As we can see, the summation of G where E is equal with 1. This coefficient, this is so-called the ARMA model. I will looking for this coefficient later. Then the second one is H, subscribe E point T, and then superscribe M. In this model, I will looking for this coefficient, summation of P, where E is equal to 1. I will looking the C, E, H, superscribe M, and then subscribe E point T minus E. I mean, I will using the several leg, but in this leg is common leg, because I do not know what leg I using later. That's why this coefficient so-called GARDS model. This for the stock market returns model. Then the second one is how do we calculate the spillover effect of return from this equation. We see the R subscribe E point T superscribe M, and then I will focus on this coefficient, so-called spillover effect of return. Commonly, to calculate the spillover effect of return, we're using the leg 1 period. But I will consider if leg 1 is not suitable, maybe I will using the another leg to get this spillover, the number of spillover effect of return. In this model, I have a hypothesis. Hypothesis null is D equal with 0. It means that there is no spillover effect of return. While hypothesis 1, D is not equal with 0. It means that there is spillover effect of return. This is my statistic hypothesis, and this is my hypothesis statement according to this model. This is for spillover effect of return. And then the second one is the spillover effect of volatility. For example, for the GARDS, I was using the H symbol. And then I will focus on L on this coefficient, or L epsilon subscript e point t minus 1 or like 1, and then superscript e square 2. This is for the coefficient of spillover effect of volatility. This coefficient will be measured by this hypothesis, the same with the hypothesis before, that hypothesis null and then hypothesis alternative or hypothesis 1 is for statistic hypothesis. And then, or we can explain this hypothesis in the common hypothesis or statement hypothesis. For example, hypothesis null is the sequence has no spillover effect on volatility, while the alternative hypothesis or hypothesis 1, the sequence has a spillover effect of volatility. I will focus on these two kind of spillover effect, both return and the volatility. Thank you.
Any questions?
Yeah.
Okay. Thank you, Ryan. Patrick? Thank you, Ryan.
Good afternoon, Professor. Good afternoon, my fellow students. Okay, this term paper will be used to study the impact of foreign direct investments on the economic growth, or otherwise known as GDP, that is gross domestic product. And it's going to be the case of the Gambia. Yeah. Oh, wait, let me. Okay, just a brief history of the Gambia, because I know it's a very remote country and most of you don't know about it. When you look at the Gambia, that is its flag, and this is its map. You can see how small it is. It's just like a snake. So it is the smallest country in mainland Africa. And then you have it here, at the tip at this right here. So it is surrounded by Senegal in almost all the three parts and only open to the Atlantic Ocean. So this is the outline. We will look at the introduction, the literature review, and then the methodology. Okay, the problem statements and the objectives of this research study. One, I will try to investigate whether there is a positive or a negative impact of foreign direct investment on GDP, and also look at whether there will be a bi-directional or unidirectional cost effect between the two. And then thirdly, we'll look at the short run or the long run, but actually if FDI causes GDP or GDP causes FDI. So we look at the short and the long run causal relations between the two. Another thing that we will be looking at will be between GDP and FDI that will enable the Gambian government to formulate policies that will favor investors who want to come to the Gambia. And then what actually motivates this, as I was searching in the net to see if we have a similar paper, similar topic, but I guess we have limited paper, not to my knowledge as at the time I was preparing this. So this study, as I was saying, will be used by the government and some other countries that may deem it fit to help advise during policy formation. So the scope actually will cover maybe from when we gain independence up till now, that is going to be around 1965 up to 2020, because 2021 is not yet included. Yeah, so I tend to look for the data so we can use it to find the causality effect between FDI and GDP. Now, the background of the study, still in chapter 1. Now, when you look at the Gambia, it operates what a small open economy, which is largely reliant on what agriculture. Okay, so agriculture is the main sector of the Gambia economy because most people are farmers. and they produce peanut for exportation, and also the rest like rice and other agricultural products for domestic use. Now, after agriculture, we have tourism. Because of its proximity to Europe, most of the people in Europe always come to Gambia for tourism. And maybe it's colonial tie with the British, because most of the people in Gambia can speak English. So, and some of the British have business adventures in Gambia, so they usually visit. So this also helps to contribute to the GDP of the Gambia. It is the second largest. And then also remittances from Gambians abroad. Now, most of the Gambians lives in abroad. Nearly every family, if not all, have somebody who lives in abroad and always send remittances in form of a foreign exchange. So this also helps the economy of the Gambia, because it is not an exporting economy. So therefore, if it is an importing economy, it will need foreign currencies to buy other materials or goods from other countries, and they need foreign currency to do this. So these remittances will lower the burden of the domestic currency. Now, this will also make it vulnerable to natural disaster and global market shock. Yeah, because it is an open market economy. Therefore, anytime there is a natural disaster or a global market shock, it affects the Gambia indirectly because of the Gambians living abroad. So if they contribute 10% of the GDP, if they are affected, then the GDP of the country will be affected. And also tourism, because if people who are coming for tourism are affected by any global financial crisis, they will not have money to go abroad. So if they don't go to the Gambia, the economy will also go down. With regards to natural disaster, if there is lack of rain, and farmers cannot have access to water, it will lead to a poor harvest. So natural disaster and global market shocks has an impact on the Gambia economy, because it is very vulnerable to these contributing factors to its economic growth. Now, another thing is that if you look at the Gambia economy, it is characterized by what? High debts and high interest rates and high government spending, according to IMF report in 2018. This is because usually Gambia borrows a lot of money to finance its domestic operations, like pay civil servants or maintenance of roads, etc., from other countries. So therefore, it is actually giving a lot of burden to its future citizens. And then, since governments need money, they usually give a higher interest rate in terms of treasury bills so that people can purchase them, and they will have money to be able to settle their day-to-day affairs. Yeah. Now, chapter 2, we'll look at the literature review. Now, foreign direct investment impact on GDP is not a new topic. So many people have wrote significantly on it. So as you can see, in Sunday in 2017, Afobia and Baka, they are from Nigeria, they write about it in 2016. And then Go Dabi also in 2016, and the rest. But if you look at these people on top, okay, they supported that foreign direct investment has a positive impact on GDP. This is because since foreign direct investment are coming from other countries, they are coming with their capital. Now, when they inject this capital in the country's budget, they actually increase the output. So it has a positive impact. But there are others who actually say foreign direct investment does not have impact on a country's GDP in terms of Tanzania and government in 2013. They contradict that. Because usually in developing countries, because they study in Turkey. Okay, they conducted their study in Turkey. So usually for developed countries, it does not have a huge impact, despite the fact that foreign currency is being injected into their economy, but the impact will not be significant compared to developing countries like the Gambia. Now, similarly again, Yakub and Ayu Delhi in 2013 conducted a research, and their empirical findings analysis shows that FDI does not grind the cost GDP, but because its couldn't be proven that FDI is significantly important to be a determinant of real GDP in their own case. Okay, and then Gunnar Sen in 2007 examined the causal relationship between inflation and GDP and employed direct causality. His empirical results indicates that causality runs from inflation to GDP for the period of 1960 to 2005. So these other guys also conducted a similar study and have similar results. Okay, the methodology and the source, the data source and description. Okay, so I intend to get the data from World Bank or IMF. Of course, I know since colonial rule, probably Gambia may not have the data, but if you check World Bank or International Monetary Fund, that is IMF, probably we will have something. So I intend to employ a series of analysis under the VECM and entirely use what's secondary data. And the data will comprise of gross domestic product for the Gambia and also foreign direct investment for the Gambia. Now, the theory that I will be focusing on will be slope, residual growth, and accounting equation. Now, these production functions present a quantitative connection between inputs and output. Because if you look at GDP and FDI, when you inject FDI, it's an input. So you can always see the output from GDP. So I think it is a good model for us to use in this study. And if you look at this equation, here Y is represented by the output, which is going to be the GDP, okay, in our studies. But nonetheless, Y is the output here, K is capital, L is for labor, and A is the total factor production. So the A is more important here. That's the total factor production. Because usually when FDI come, they don't only bring in money, but they bring in what? Technological advance. So this technological advance actually augments productions in the host country. So the A is going to be used as the foreign direct investment in terms of the technology that they bring into the country to augment production. So the higher A is, the more output we will produce. So the more technology we have in the developing countries, the more output we are expected. Because technology only will help you to double up your production or even triple it. So by assumption of the CRS with respect to K and L, which is capital and labor, and CRS is your constant return to scale. Okay, so by the assumption of the constant return to scale with respect to capital and labor, equation 1, which is this equation, can be transformed into a specific link between input growth and output growth. And that is what Robert Slow quoted, okay, in his growth accounting framework from 1957. Now, since when we look at, we can use equation 1 and manipulate it in order for us to have this. Because we can see that changes in Y is equal to what? Changes in labor plus changes in capital plus changes in what? Technology. Okay? So here, the growth, which is changes in Y, is equal to what? Labor share plus labor growth plus capital share times capital growth plus total factor productivity growth. This is total factor productivity growth. Okay? So the slow residual is measured by turning equation 2 around. So if you want to measure what the technology advance actually contributed in the GDP, we can turn this equation 2 around to have equation 3, which is what? This total factor productivity is equal to what? Changes in growth, okay, minus labor share times labor growth minus capital share times capital growth. Okay, I hope you understand how the equation is transposed. We just make this one the subject of the formula, and then take this, all of this to the other side, so they will be negative. So when we subtract this from this, we will be able to know the total factor of productivity, which is the FDI. Okay, the empirical model. Now, gross domestic product or economic growth, which is going to be the dependent variable. And the FDI, which represents foreign direct investment, is going to be the independent variable, respectively. So when you look at the empirical model, we have GDP is equals to alpha plus FDI. Okay, it's more or less like an econometric equation. Okay? If this increase, this will also increase. If this go down, this will go down. Okay? And this is the constant. So the alpha here is the intercept, and the B is the slope coefficient for FDI, and the E is the error term. All other factors that may affect GDP, okay, but not included in this model. So they are in the error term here. Maybe exchange rate, export or imports, and so many other factors that have direct impact on the GDP. Since we are only using a simple model of FDI and GDP. Now, the structure of the analysis. First of all, I will conduct a unit root test to examine the relationship between the variables and check for stationarity. And then I'll also use augmented Dickey-Floyd test to check for stationarity, yes. And then the Johansen co-integration test to examine the co-integration relationship among the variables. And also check if the said variables are integrating at the same level. Okay, and then I will use the vector error correction model and Granger causality to check the direction of the relationship between the variables in the short and the long run. So if, for example, if it is too much, then I may only use the vector error correction model and Granger causality. That is if the variables are stationary at the same level. But otherwise, I will have to conduct all this in order for me to have a better analysis of the data. These are the references so far, the papers that I read, and some books. I read Matthew, so where I get pseudo growth model, and Gujarati for the econometrics. And these are papers that have been published on a similar topic. Thank you.
Any questions for
Oh,
Crash?
sorry.
I think this is an interesting topic according to economics field, when Patrick wants to try to focus on one specific country, so-called Gambia. And then if we are looking for the title, in my mind, I'm thinking about, we have two variables. One is the GDP, and one is the foreign direct investment. But the methodology, Patrick said that he will using the GDP or economic growth. My question is, which one do you use, GDP or economic growth?
GDP represents economic growth, because when you look at the GDP, it's the total amount of goods and services produced within a year. So if it is actually huge, then it is going to, the standard of living will be uplifted. And if the standard of living is uplifted, the general welfare will be taken care of, and which is what economic growth. Because if GDP grow, economic growth grow alongside. If GDP fall, economic growth falls alongside. Because GDP is a measure used to look at the overall economic growth of the country in each year.
So you use GDP, right?
Yes, so GDP is going to represent economic growth. Because economic growth, you cannot quantify it. So, but what you can use to substitute it can be what? Gross domestic product. Since it is the total output of goods and services generated within a country from within 1 year. Yeah, so if it is good, then there's good economic growth. Because from GDP we can check for how to call it again, gross national product. We can check for capital. Per capita, yes, that was what I want to say. You can check for capital, and if per capita is good, which means the general welfare of that citizenry is also good. So GDP can be used for economic growth.
So if I can say that your proposal is related to the FDI-led growth. FDI-led growth, right?
Yes, but watch out here. FDI here, according to SLO, because if you look at the SLO model,